Index funds, ETFs, mutual funds. Which one is right for you? Well, there's no particular right or wrong answer. Let's break it down what each of them are and the benefits to each. Index funds can be in the form of either mutual funds or ETFs, and they give broad diversification into the markets because they're investing in an index. You can pick almost any index of your choice, and some of them can even be made up by a particular fund manager, such as maybe a Russell 100 index or maybe an S&P 50 index versus the S&P 500 index. So the indexes can be indexes that most people are familiar with. They can also be indexes that most people are not familiar with. And it's a great way to get diversification, typically at a low cost. ETFs, on the other hand, often are intertwined with index funds because they typically do track particular indexes, but some ETFs don't. Some might be invested in certain types of bonds. Some might be a blend of bonds and stocks. Some might be certain stocks maybe in a sector. Think maybe the technology sector or the healthcare sector. ETFs can be a great way for investors looking to get further diversification outside of index funds at a very, very low cost. ETFs tend to be some of the cheapest investments available in the entire stock marketplace. Mutual funds, on the final hand, can really do all of the above. They tend to be a little bit more costly than the other two types of investments of index funds and ETFs because there's a fund manager or fund management team behind the scenes making investment decisions. This isn't a bad thing per se, but it's just something to keep in mind. Mutual funds can be much more precise. They can invest in an index, they could invest in sectors, or they might want to try and target particular stocks or particular bonds. They might want to only buy Microsoft, Apple, and Google stock, and they can be very, very precise in doing so and allow investors to get into these types of stocks at a very low premium because mutual funds tend to be a lot cheaper to buy versus the individual stocks themselves. So that's why they cost a little bit more, because you're paying for that premium to get very, very precise investment strategy within your portfolio. Unlike an ETF and an index fund, these types of funds can't be as precise as a mutual fund. Again, there are pros and cons to each type of fund. There's no right or wrong way to approach these investment decisions, but when you're considering these types of investments, it's always prudent to work with a financial planner that acts as a fiduciary to help ensure that these investments are the best fit for you, your goals, and your portfolio.